Ladies and gentlemen, good morning. All distinguished guests, good morning. It's a great pleasure to welcome you at this conference where we aim to address a pressing global challenge, climate change and its profound impact on our economies. In the face of climate risk, we all bear a personal responsibility to contribute to solutions. Each of us can play a role in safeguarding the health of our economies and the planet. However, the broader task of addressing climate change, particularly at the national and international levels, falls more or less within the purview of governments and specialized institutions. Among them, central banks play a crucial role. Climate change is already affecting our economies and financial system, consequently also our financial stability and monetary policy, which are, of course, our core mandates. In recent years, the Eurosystem central banks have translated our commitments into concrete actions by adopting a roadmap for climate-related initiatives. In the area of monetary policy, we have initiated the analysis of climate-related factors to our macroeconomic models. We have also begun to integrate these models into implementation of our monetary policy, including our collateral framework and corporate practices, and corporate asset purchases, In terms of our non-monetary policy and non-monetary instruments, we proudly published this year our first report containing detailed climate-related information about our entire financial assets. This was done on the European level. This report underscores a significant progress over the last 5 years, notably in divesting from firms in the tobacco and arms industries and those causing substantial environmental harm. To reach our long-term objective of approaching to net zero greenhouse gas emissions of our financial assets by 2050, we have set 2 medium-term goals to be achieved by the end of 2025. Firstly, we intend to increase investments in green, social and sustainable bonds from currently around 7% of our assets to 10% of our financial assets. Secondly, we are committed to visibly reducing the carbon footprint of our investments in private sector issuers. We have already commenced measuring and reporting carbon footprints along with other indicators of social, responsible, and sustainable investing. In terms of bank supervision, central banks have a crucial role in establishing uniform standards for addressing climate-related risks by adopting banking regulations and supervisory frameworks. Our activities encompass the measurement, assessment, management, and disclosure of climate risks. Notably, last year, ECB and national competent authorities conducted the first climate-related stress tests, albeit recognizing that this process is still in infancy. However, these stress tests revealed that banks derived just over a fifth of their interest income from carbon intensive sectors. For commercial banks and broader financial system, addressing climate change presents not only challenges but also opportunities. The transition to a green society demands substantial, significant investments in the financial sector, especially banks. And here they can play a crucial role in providing, of course, financial resources that is needed. Dear ladies and gentlemen, as I have outlined, numerous challenges lie ahead, underscoring the importance of today's debate. Our conference seeks to address the questions how we can finance the sustainable transition to a carbon-neutral economy. We will explore indispensable roles that financial institutions and businesses play in this transformative yet interesting journey. To commence our discussions, we are honored to have opening remarks by Vice President of European Investment Bank, Teresa Czerwinska. Our keynote speakers include Debora Revoltella, Chief Economist of European Investment Bank, who will share the latest research findings on investments in Slovenia, with specific focus on climate change. Additionally, my colleague Katja Koren, Director of Banking Operations at the Bank of Slovenia, will shed light on our investments practices in socially responsible and sustainable investing. At the heart of the event lies a panel discussion moderated by my colleague Vice Governor Tina Žumer, featuring distinguished experts from various sectors. Let us engage in a fruitful debate, for together we can drive the change our world urgently needs. Thank you.
Good morning, ladies and gentlemen, dear Deputy Governors. It's a great pleasure to be here today. Thank you very much for the invitation to this event. And as a co-organizer of the event, so we are proud to be here with our strong team from European Investment Bank. And I must say that the topic of today's conference is particularly relevant for Slovenia. The devastating floods which have impacted the country so much only a few weeks ago are a tragic reminder of the climate change, of the need to accelerate and scale up our climate action together and to promote sustainable and inclusive growth in line with the objectives of the Paris Agreement. So let me take this opportunity to convey our highest esteem and appreciation for the work carried out by all Slovenians. It's truly remarkable to see how the country is already advancing in the post-flood reconstruction. In this respect, ladies and gentlemen, I can assure you that our teams in Luxembourg and in Ljubljana are working intensively on how the EIB can support Slovenia during these difficult times. Now, looking a little bit at overall macroeconomic environment for investing, let alone in green projects, remains challenging. The recent European Commission's summer forecast indicates that we are already facing this year an economic slowdown at EU level, with few important countries, notably Germany, already under recession. A slowdown in growth is also expected in Slovenia. However, the good news is the resilience of investment through these difficult years, especially in building and key transport infrastructures. Looking forward, the outlook remains uncertain. Emerging but also advanced economies continue facing higher borrowing rates, credit standards have tightened, while public finances are under strain given rising interest rate spreads and pressure to consolidate after the supportive stance implemented in many countries to counter the impact of the pandemic and the energy crisis. And according to the estimates, only about half of the discretionary stimulus provided in response to the pandemic and energy shock is expected to be reversed by 2025. So such discretionary measures are leaving fiscal policy accommodative and are not sufficiently offset by efforts to increase public investment that could help reduce the mid-term inflationary pressure. So I think, therefore, is of paramount to understand which investments we should prioritize and how. And I also fully agree with my previous speaker, Deputy Governor, who said that we need to think how to mobilize private capital, businesses, because it is very important to match public financing with private. And I'm sure we will learn a lot from the conference today in this regard. In the area of climate and environmental policies, Slovenia is to be commended for reducing its carbon intensity by more than a third over the 2005-2011 period, in line with the EU trend. Mostly thanks to hydroenergetic power, its overall share of energy from renewable sources is higher than 25%. So it's amazing achievement, but challenges remain to further reduce greenhouse gases emissions from the transport sector and mitigate the high exposure to climate change-related damage. And we need to think today how we can use this challenging macroeconomic and environment as an opportunity to accelerate the green transition, similarly as we use the pandemic for boosting digital transformation. In this context, the EIB Group is doing its part under the guidance of our Climate Bank roadmap. The goal of increasing EIB investment in climate action and environmental sustainability to more than 50% of annual lending by 2025 was already achieved since 2021. And last year alone, the share of EIB investments that went to climate action and environmental sustainability projects rose to 36.5 billion euros, which is 58% of total EIB investments. We are also looking at the goal to support up to 1 trillion of green finance in this critical decade. The EIB Group, of course, is also very active here in Slovenia, supporting the country since 1997. During the last decade, EIB operations amounted to some 3.4 billion euros in committed funds, supporting all key sectors of Slovenian economy. This is the highest per capita exposure of the EIB in EU member states. We have been supporting investment in innovation, small businesses, renewable energy, and key infrastructure, including in the digital domain. Our subsidiary European Investment Fund activity in Slovenia since 2004 was also intense, with a total of 400 million euros in direct financing and leverage financing for 1.6 billion euros, owing to strong utilization of guarantees from the European Guarantee Fund. The first contracts for the InvestEU guarantee agreements were already signed this year, and further agreements are being discussed with our Slovenian partners, while the EIF remains strongly engaged in supporting capital market in Slovenia as well. So that said, ladies and gentlemen, I'm here to confirm the message that EIB stands ready to support Slovenia's very ambitious green agenda to unlock its key advantages, including a strong social model and an educated workforce, and to develop a growth model that is both competitive and sustainable, serving as European example of success. So with these words, I am looking very much forward for the discussion today, and I wish you a very successful morning. Thank you very much for your attention.
Thank you very much, and it's really an honor to be again here in this room to have the opportunity of presenting our work on a survey of European firms, also with Slovenian firms, that we develop every year in order to have a pulse of the investment dynamics, and then particularly on green investment, with a special focus that we are looking this year. It's in Slovenia, I have been told that I tend to surprise people because everybody thinks I present one way of the survey and then I come with the newest one. That's what I'm going to do today. In fact, we just received the new data, and that's what I'm going to show you. This was the survey that was run during the summer, so it's really, really fresh. We need to, so we will formally launch it in 10 days for Europe, but I am doing a sneak peek today. So what we see, and I would start from the European context on investment. So that's European-wide. What we see is a weakening of economic dynamics. So we see some first sign of a weakening of economic dynamics at times of tight monetary conditions that are also reverting into tightening credit standard and also rising borrowing cost for the corporate sector. So the scenario that we see on the macro point of view is decelerating growth and rising cost of credit for the corporate sector. And my focus is obviously, it's a very much a corporate investment. When we look at corporate investment, what we see is that at the European level, we are kind of a positive surprise of how corporate investment is behaving in the context of a decelerating growth and tightening monetary and credit condition. We still see corporate investment somehow resilient, but with a very strong differentiation across countries. If you go to Spain and Germany, they are less convinced of the resilience. But if you go to other countries, and actually Slovenia is, with some one-off effect, is quite resilient as well, but also Italy, policy support related to the post-pandemic period, you see investment, corporate investment quite dynamic. Then the answer, the reason why corporate investment is so dynamic, we think there is a lot of temporary factors. On the one side, corporate were building buffers during the last years. Actually, the corporate sector was building profits, maintaining, accumulating savings, and now they can rely on these savings, or if you want, internal finance, to continue to invest. And also what we saw, and I'm still talking about European data, there was a lot of capital transfer from the public sector to corporates and the private sector. And that's, again, is the policy support that is helping firms in this dynamic to continue to invest. But these are things that are buffers built that slowly will be depleted. So as buffers deplete, continuing this positive performance will mean using more external finance, and the cost of finance that is skyrocketing will bite more. So if you talk about now, or the data that we see now, we tend to be optimistic, saying corporate investment is holding up, but there are a lot of temporary factors that are supporting it. If we look at Slovenia, in fact, what we see is that what I was saying before, investment has remained positive. I understand that there are also factors related to the railways industry, the usage of EU funds that is supporting the investment activities, and actually net export and investment remain drivers also for GDP growth. And if we look at the composition of investment, we see a big part of other building and structure. I assume that also the railways is coming in this component. And then if you look, you have a combination of private and public investment, both contributing to it. Now we turn to the result of the survey. What we see is, in fact, that investment, and here this graph shows, so it's two graphs. The one at the bottom is the net, is the outlook of firms. So expectation for 2023 investment relative to 2022. And it's a net effect, so those expecting an improvement minus those expecting a deterioration. A positive number means optimistic outlook. And what you see is actually dynamic. It's positive, always positive, but is somehow slightly declining, but remaining on the positive side. So overall, Slovenian firms think that the investment outlook remains positive. it could still be that the positive that I was mentioning before are still expected to stay. And the other graph shows the share of firm investing and this outlook on the vertical side, where you see Slovenia was starting from before the pandemic with a high share of firms investing, but a relatively negative outlook. And then you see the movement, and now it's going back to a positive dynamics. You have larger firms in manufacturing, particularly on the positive side in terms of investment dynamics. So the cycle still remain good. But then if we look at another indicator, that is we ask firms what is their view for the next year in terms of some factors that are drivers of investment. And what we see is Slovenia very much goes online with the EU views, more or less. But what you see is political and regulatory climate, economic climate are drag to investment, both in Slovenia and at the EU level. Then the very interesting point is external finance. There Slovenian firms are more negative than the European one. So when the external finance will really start mattering, when all the buffers are depleted, then this will be a strong effect. And the Slovenian firms start being more concerned about this external finance matter, and still they remain muted in terms of internal finance. And now I turn to the climate part. And here we have two points that we look at. At the European level and in the Slovenian level, what we saw was a lot of acceleration in energy efficiency investment. For various reasons, and I will show later a lot, it's also related, of course, to the energy crisis, that both the energy efficiency investment are really at the forefront for firms. We see also in Slovenia actually, there is a strong pickup on the percentage of firms that are investing for energy efficiency, and this is particularly in the manufacturing sector and particularly for large firms. We have a second definition of investment in climate. It's not only energy efficiency, is defined as investment to deal with physical and transition risk, so it's a bit more vague concept and wider. And here you see actually that the Slovenian firm continue to have the same share of firm investing, somehow matched to the European one, but they start thinking more about this investment. So more of the firms say we plan more of this investment for the future. It seems, and we have more studies around it, that what the firms did during the pandemic was, during the energy crisis, was the first thing is you deal with it, energy efficiency, but at the same time you start to think at the future and you also prepare for climate investment. Then the energy shock, and that's really what I was mentioning before, a positive story, but also a concern for the medium to long term. We ask in the survey if firms experience increase in the energy cost, and also by how much, less than 25% or more than 25%. What is really interesting is the comparison EU and Slovenia, but they behave quite similar versus the US. You see how strong the energy shock was in Europe. And you really see in the numbers the percentage of firms that perceive an increase of energy costs more than 25%. And then we ask firms how did they react to it. Large share of firms, and much more in Europe and Slovenia compared to the US, energy savings, which can be energy saving or energy efficiency investment, but also a big chunk of pass-through to the final consumers. So there were these two elements going hand in hand. So the good part of the story is a strong shock, brings firms to transform, and particularly the energy saving, energy efficiency investment. But the negative part of the story is that at the end, energy prices remain high in Europe, even with all the adjustment, the volatility that we see. Actually, we have seen in the same time a lot of focus on renewable investment coming up. What the concern is that also that before the whole effect of the renewable energy investment will materialize in a system in which renewable energy will really set the price for energy, it will take time. Some experts are saying around 50 years. It will not be immediate. So it's a longer period in which European corporates will have to live with much higher energy prices. And that has issues in terms of competitiveness and even more cause for accelerating all the positive investment in energy efficiency, more renewable, etc. So it makes everything even more pressing. Another point, we ask firms whether they already had costs associated to physical climate risk. The survey was run also during the summer, but it was finished in June. I think we see that there is awareness of physical risk. In Europe, in Slovenia, much more awareness, more for larger firms. What is interesting is looking at what the firms do once they experience physical risk. And the second part of the story tells us that, so two things I think are interesting. On the one side, if you see the percentage of firms that perceive the physical risk is around 70%. The percentage of firms that do something is around 40%. So you have a number of firms that add costs associated to physical risk and don't do anything. So this is a gap that you have at the European level and you have also in Slovenia. Maybe a bit lower in Slovenia, but it's still there. And then if you look at what the firms do, there is a lot of strategy, which is good, is not an investment. And you have, and that's also a question that I had, there seems to be at the European level very low share of firms that insure themselves against physical risk. In Slovenia, it's a double than the European is still low at some 20-25%, but it's still low. So the question is the insurance market for physical risk really working or not? And it seems to work better in Slovenia than in other countries, but that's something maybe that is worth looking at in the future. Transition risk perception, here the question asks to firms whether they think that the climate transition is a risk or an opportunity or will have no impact on their business. What we see is that in Slovenia, firms tend to be more concerned, so they tend to perceive more the risk rather than the opportunity, and particularly the larger firms. When we ask them what they do about it, you have a lot of firms that actually are reacting with some measure, a lot of waste minimization, that's also at the European level, a lot of energy efficiency, and I was just mentioning it, that's even increasing over time. And what I find interesting is also we have one question, and that's the second one, that is conceived to think at the firms that are in a challenging sector or challenging business model on a climate perspective and try radical transformation. And in Slovenia, there seems to be a little bit more aptitude to go in this direction. Then the last point we have is we always have a mapping of barriers to investment. That's on general investment, overall investment, and we come back always to the same topic in the last years. So first of all, availability of skills. Availability of skills is a major impediment in Slovenia, even more than at the European level, and at the European level is already a very strong impediment. So skills is really, availability of skills is a really important issue for firms in the country. The other one is energy cost and uncertainty that still remain important. And we have a number of other elements, including a business regulation, labor market regulation. They may not top as the other one, but they still remain a constraint for firms. Overall, I think the message is so far relatively positive on investment, but we are concerned because buffers are depleting, the economic dynamic are turning, and on the other side, the cost of credit is already quite high and will start biting soon as buffers are depleting. And investment needs remain important. So we may be going in the right direction, but we have to make sure that from here on, investment and investment in the right thing. So I think I was talking a lot about climate, but I think also the innovation and digitalization part is very connected to it, has to continue to go on. And on policy support, I think a lot of the focus on investment that we have seen has also been supported by policy support and by public investment going in some areas. Going forward, I think the room for continuing broad support will definitely be reduced all over Europe, and I think it will be important to find a very targeted instrument that allow the public sector intervention to really be catalytic in the kind of investment that we really need, and I think the climate part is one of the most important ones. Thank you very much.
Good morning, ladies and gentlemen. I'm very honored to be here to present how we at Banka Slovenije incorporated sustainability-linked considerations into the investment framework of our own funds. Well, climate change is one of the main challenges of our time. Primary responsibility for improving environmental standards lies with governments. Nevertheless, central banks are among the largest institutional investors. That is why we aim to set an example for other institutions, and we strive to raise the awareness and public understanding of climate-related risks and opportunities. So the focus of my presentation today will be on our first climate-related disclosure of our financial assets. And during my presentation, I will also touch upon the key challenges that we have identified during the process of this integration. Over the past years, we have been continuously developing our socially responsible and sustainable investment framework with the aim to actively contributing to the transition to a low-carbon economy. In this process, we are striving to improve the quality and transparency of data. So our disclosure shows the improvement, our progress in decarbonizing of our own funds, and it helps us build or form the most effective way towards the goals of the Paris Agreement. Through greater transparency of our own activities, we strive to contribute to better overall understanding of and awareness of this topic. I will now briefly explain our journey of socially responsible investing that we have taken so far. So it started in 2015 when we began investing in non-financial corporate bonds. And back then, having limited data, we decided not to invest into corporates, into issuers from tobacco industry. We have developed more concrete discussions regarding socially responsible investing 3 years later, in line with the discussions at the Eurosystem level, which were about forming a common position regarding the integration of socially responsible factors into the Eurosystem central bank's own funds. So later on, we began to systematically increase our investments into green bonds. And moreover, we have excluded additional companies from the eligible list of our corporate bond issuers by applying a publicly available exclusion list of one of the largest pension funds, which is operated by the Norwegian Investment Fund. Further on, we increased our investments into green bonds, and we also start investing into social and sustainable bonds. And this year, we made a significant step forward by setting a long-term climate-related target and 2 medium-term targets for our financial assets, and we have disclosed for the first time the climate-related information for our entire financial assets. Now, let's take a look at our disclosure framework. All Eurosystem members took part in the development of the common disclosure framework, taking into account as much as possible the guidelines by the Task Force on Climate-Related Financial Disclosures, so the TCFD Task Force. And all Eurosystem members use data from 2 providers who were chosen via joint procurement at the Eurosystem level. We at Banka Slovenije believe that transparency of climate-related risks and opportunities within our financial assets is of utmost importance, and that is why we have decided to broaden the disclosure framework that was set at the Eurosystem level. So we are disclosing climate-related information for our entire financial assets. We disclosed backward and forward-looking metrics with 5 years of historical data. Besides setting a long-term qualitative target, we also set 2 medium-term, more concrete targets, and we are reporting on all 4 TCFD recommended elements, which are governance, strategy, risk management, and metrics and finance. This slide shows the set of metrics that we are disclosing for our sovereign bonds and non-sovereign investments. So we disclose 4 backward-looking metrics, 3 forward-looking metrics, and the volume of our investments into green, social, and sustainable bonds. So the backward-looking metrics that we're disclosing are weighted average carbon intensity, total carbon emissions, carbon footprint, and carbon intensity. And as for the forward-looking metrics, we can see from the slide that they're only available for non-sovereign bond issuers, and within here, we are disclosing greenhouse gas emission reduction targets, temperature score, and carbon risk rating. Now, I will briefly summarize the main findings of our disclosed metrics. So here we can see the results of 3 backward-looking metrics for our sovereign and non-sovereign investments. So in general, the higher number of backward-looking metric means higher or deteriorating carbon footprint of the portfolio. So as you can see from these charts, our backward-looking metric for both sovereign and non-sovereign investments have somewhat improved during the last 5 years. The reason behind this was the general reduction of emissions by sovereigns and non-sovereigns in general, and due to our increased investments into non-sovereign issuers from less carbon-intensive sectors. This slide shows climate-related targets for our financial assets. So our long-term climate target is that our financial assets approach net zero greenhouse gas emissions as much as possible by 2050. So this is in line with the EU's climate neutrality strategy supporting the Paris Agreement. We have also set 2 more concrete medium-term targets, which are to be achieved by 2025. So with the first one, we aim to increase investments in green, social, and sustainable bonds. And we also aim to visibly reduce the carbon footprint of our private sector investments. Now let's look at our medium-term targets more closely. So the first one, as already mentioned, is to increase our investments into green, social, and sustainable bonds to at least 400 million euros by the end of 2025 within our financial assets. So that would be roughly 10% of our financial assets. And as you can see from the slide, we have been increasing such investments during the last 5 years from less than 1% to more than 7% of our assets. By further increasing our investments in such bonds, we will provide additional financing for projects that contribute to decarbonization of the real economy and to the general improvement of the socio-economic situation. And our second medium-term target is focused on significantly reducing the carbon footprint of our investments into private sector issuers. So this year we have decided to update and to considerably tighten our exclusion criteria for non-financial corporates by following the EU Paris-aligned benchmark recommendations. So by following these criteria, which are presented here on the right-hand side of the slide, we will discontinue investing in carbon most intensive companies. Moreover, we will continue to exclude companies from tobacco and weapons sectors. And by doing all this, we aim to visibly reduce the carbon footprint of our corporate bond portfolio by additional 30 to 50% by the end of 2025, as per our current estimations. So in the future, we also plan to set carbon footprint lowering strategies for other private sector investments. So next year, our focus will be on equities. We will aim to switch our current equity exposure to low carbon equity ETFs. At the end, I would like to highlight some of the main challenges that we have identified during the process of integrating sustainability-linked factors into our asset management. So one of the biggest challenges was setting the targets, because currently there's no consensus nor best market practice on how to set a quantitative long-term target to be in line with the Paris Agreement. There are also significant issues with data. A large share of companies do not report climate-related data, and methodologies of data providers differ, which may lead to big differences in estimated climate-related data. One of the issues is also double counting or multiple counting of emissions. And last but not least, we also faced a challenge on how to efficiently perform climate-related metrics calculations. So let me conclude by saying that all these challenges represent motivation for us to further work to better understand, to monitor, and manage climate-related risks and opportunities within our investments. We will aim to increase transparency in this area. Of course, this will largely depend on climate-related data availability and quality, and on further development of methodologies and the harmonization of methodologies by data providers. With this, I'm concluding my presentation. Thank you for your attention.
Good morning, everybody, dear panelists. I'm really delighted to be moderating this panel today on this very important topic, which is how to finance and implement the transition to a low-carbon economy, which is the only sustainable economy going ahead. So we see the climate change has been happening around us. It's been affecting us. We have had very long heat waves, fires, droughts, severe floods. Slovenia was very heavily affected by floods this summer, 2/3 of the country. And there are also other figures. For example, the scenario of the network for the greening of the financial system tell us that in Slovenia the GDP level would be by 3% lower if current policies continue, taking into account physical risk only. This is without extreme weather events. And of course there is a lot of uncertainty about these scenarios going ahead, but this should not prevent us from acting. On the contrary, I think we should really get together with collective action and try to reduce this uncertainty, gather more information and knowledge, and this is also the aim of our panel. So, before going to the topic, let me introduce quickly our 6 distinguished panelists. I will do that in the alphabetical order, starting with Patrick Ami, who is the Director General at the ECB, entrusted with the supervision of 55 significant institutions, as well as less significant institutions, but more importantly for the purpose of this conference, Patrick has been in charge and responsible for incorporating climate risks into the European supervisory framework. Next, we have Daniel Hardy, who is a senior researcher at the Vienna Institute for International Economic Studies. Daniel had worked for many years at the IMF, and among other things, he has been recently writing about the designing of the sustainable and green sovereign bonds. Elina Kamenitzer, the director of the operations support at the EIB, and prior taking up this position, Elina set up and led the climate center of the EIB that led to the transformation of the EIB to the really EU climate bank. Next is with us Alenka Recembercina from the Nova Ljubljanska Banka Group, head of sustainability at NLB, but also the chair of the Sustainable Finance Committee of the Slovenian Banking Association. My dear colleague Sandra Švaljek, Deputy Governor of Croatian National Bank. Among other many areas of responsibility, Sandra has been very active in incorporating climate aspects into the central banking and financial sector. And then finally with us is Peter Vosner, who is a researcher at the Slovenian Institute for Economic Analysis and Development, who incorporates also the National Productivity Board, and Peter is chief editor of the National Productivity Report. So we have gathered really, I think, very various perspectives to cover this topic. So we will have the panel discussion of, I will have 2 rounds of questions to each panelist. And at the end, we will have a discussion when we will invite the audience. Also, if you want to address the questions, I'm sure we'll come back to the topics that were addressed in the keynote speeches at the beginning. So let me start first in the first round with the discussing how the climate change is actually affecting the macroeconomic landscape and how it's affecting our policy making, and also especially going forward. And with that, I would like first to ask Peter, to achieve the net zero economy, all sectors will need to adjust. So of course this brings opportunities, but it also brings challenges, and maybe for some they will be left out with the non-viable businesses. So how do you see the progress made so far, and what would further delays mean for the long-term macroeconomic trends.
Okay. Thank you very much for the question. Thank you very much for the invitation. Our last year's productivity report indeed was focusing on climate change, so the green transition. I'll be glad to share some of the insights from there, but also we are in the midst of preparing the 2023 report, which will be looking at the future of work. So it's something that indeed will impact all of us. Before I go there, just to say that I'd like to thank to the EIB. The data that you're collecting is really important. On the national level, it's this kind of inputs that really matter so that we are better aware of where we are. Slightly bigger sample size of firms would be even better, but it's very valuable input indeed. So first comment to your question is, one of the things that we really tried to underline last year was this concept of integrated smart circular economy. Because at the end, when you look at what's going on in the corporate sector, what you see is that you have two types of firms, one that are transforming and others that are not. And those that are looking both at green, digital, and other transformations. So, that's something that we really to keep in mind, because sometimes, we have events or policy recommendations dealing with green, which is one part of the policy sphere, and then the other one. But in fact, it's integrated process. Why does it matter? Was your question. It matters because the evidence shows that companies that are more sustainability oriented, that are taking into account the ESG criteria, etc., are creating higher revenue, are more productive, are more profitable, have already, and will even more be the case in the future, have easier access to capital. Much more importantly, perhaps for the future, they will have easier access to labor, to employees. And that's something, sometimes have a feeling, you talk to firms here, it's something as if this would be some distant future. It's already here. Sometimes, it's ask people that are, in their 30s, they really do care. They care what kind of policies the firms are implementing. Also on a very kind of, what you could say, kind of, not just the big things, but also the small things. It matters. So overall, it economically matters on the micro level, but also on the macro level. So on the macro level, the analysis on the EU level suggests that you could create, 1 to 2.5 million net jobs from the green transition. By the way, in Slovenia, the share of green jobs is below the OECD average, and the share of brown jobs is above the OECD average. The good news is that according to the data on the types of occupations that we have, the transition should be relatively easier to the average. So in fact, one should ask why aren't we doing better? Why aren't we faster? So this is the kind of question that we asked jointly with the engineering faculty from University of Maribor last year. Indeed, these were only firms from the manufacturing sector. And the answer is, number one, because it costs money, so it's the cost. But second is really suggestive. It's because companies don't know. Companies don't know what the benefits of investment will be, and companies don't know what kind of technologies to invest in. The title, the joint title I would kind of brand this under would be uncertainty. We are really over here, everywhere, but here in particular, and the data from Debora's presentation shows that we don't like uncertainty. We're not comfortable with uncertainty. And that's something which brings me to the third part that I want to comment. It's this somewhat conservative attitude that is part of the problem, because in this kind of environment, and that won't change, the environment is much more unpredictable than it used to be, and that will not change. Companies do not exactly know what the price of different energy sources will be. You do not know exactly what kind of technologies will dominate in the future. And that's something, again, we have not been comfortable with. Why not? Because we've been catching up. 30 years ago, over here, It was, you know exactly, the firm knew exactly what kind of machine to buy. It went to Germany, it bought it, you know exactly how it will increase their productivity and how much it will cost. Today you don't have that, and certainly that's something that we need to adjust to. And that's something that is not easy to do because it's about the attitudes. And there, you know, just 3 points and then I finish. For example, if you talk to companies in terms of, you know, to what extent the market is already taking into account, the consumer is already taking into account the green dimension, they will be, you know, not at all. At the same time, if you look at the surveys done, you actually see that they are taking into account, not necessarily in the sense that they're willing to pay more, but they are taking into account, for example, the ESG criteria in terms of which product they buy in the first place, which matters. Now, when you dig deeper in terms of why companies are not achieving higher price, even when they invest, for example, when they come up with a product which is much more energy efficient, for example, they say, we have not seen that our price increase at all. And then I asked, you know, but have you invested in rebranding? Have you done this under the new brand? No. And that's something we tend to forget. You know, it's why are these companies better? Well, because they have differentiated products that the consumer is willing to pay for. So it's not just that you make the same kind of product more energy efficient. It's the whole transformation of what you do, how you position yourself on the market, that is the necessary condition to really make this green transition work. And that, again, is something, not just in terms of the structure of the economy that we have, but indeed something that needs to change in the way how we function. And then, you know, the data in terms of whether we see green transition as an opportunity, you know, we're very back. We go towards the back of the line in the EU. You know, why are companies going for green transition? Well, because of the regulation, second among the 19 countries that the data is available for in the EU. To what extent we're going for it because of the market-driven pressures or opportunities? 9th among the 19. You know, it's not dramatic. You know, we're on the average, but you know, it's this kind of attitude that I will argue that we should go beyond. You know, it's averages. Averages are not enough. So if I draw the line, I would say, you know, this mentality of kind of adding the sustainability ESG layer on what you do already without changing it is part of the problem. You are making additional value, you know, a jump forward when you transform what you do all the way. And that means different kind of products, differentiate products. And that's where we will need to kind of put, you know, we'll need to notch up the gear in terms of what we're doing. There are some good news, but I'll wrap it there and perhaps come to it later. Thank you.
Thank you, Peter. Thank you for this insightful start. So the buzzword was uncertainty, knowledge, skills. So this is so that there is room for improvement, of course, going ahead. And but looking back, despite the obvious negative consequences, the progress on the European side has been relatively limited. We have seen that, and I'm turning now to Elina for the findings of the latest EIB report, where when we read, if still valid, if maybe not updated, is that only 1/3 of the firms that have been impacted by the climate change already only invest really into the new business models and strategies. We have heard a little bit from Peter's perspective, but maybe your perspective on what is behind and what could be done and the role of the EIB in that respect.
Thank you. And then say a few words what the EIB can do actually to overcome these barriers. First, the positive news. I think the EIB investment survey does reveal that a large majority of the European companies are actually investing in climate-relevant assets and business transformation. However, as the previous speaker mentioned, these investments are often incremental and not really focused or targeted on a real step change and transforming the business models. And also, I think it's important indeed to highlight that while a lot of the companies start to be impacted by the climate change, still adaptation and investments in resilience are at the very low level. And I think it's important to say that indeed we are moving to the right direction, but putting the current investment levels in the context, if we want to get to the 2030 targets, climate targets of the European Union, we would need to invest over 350 billion more annually to green transformation over the critical decade, 350 million more than we did in the previous decade. So the investment gap is massive, although we are indeed moving to the right direction. So why are the companies not investing? Again, I want to make 3 points. First, the investment climate, including the regulatory framework, then the business case for green, and then the knowledge gap that was already mentioned also by Debora in her opening remarks. So the investment climate first, it is challenging, and there is a lot of uncertainty that is not conducive for accelerating investment. The macroeconomic uncertainty has further been heightened by the war in Ukraine, and the consequent hikes in the energy prices that remain indeed persistently high and are impacting on the firm's ability to invest. And of course, the investment costs have increased as the interest rates have been rising. So not such a conducive environment currently for firms to invest. However, I think it's good to note that the ambitious regulation is pushing companies to address the climate challenge and bring the climate closer to the core of their business strategies. But the companies are very often still viewing the climate and the climate policies as a constraint rather than an opportunity. And I think we do need there a real paradigm shift. And that brings me to my second point on the business case. It does seem that large number of firms do struggle to still make the case and put together the business case for green. And in fact, again, our survey shows that only around one third of the companies perceive the climate transformation or the low carbon transformation as an opportunity. And a large number of firms, on the other hand, view it as a risk. And if you are indifferent or view the climate transformation as the risk, you are more likely to adopt sort of a wait-and-see strategy when it comes to investment. And certainly, you may not be enticed to make these step change investments, business transformations that oftentimes are more risky and require sort of acceptance of uncertainty. And then my third point, the knowledge gap that was mentioned. The companies that want to transform or make and progress in implementing more carbon neutral business strategies do struggle to find not only climate experts, but also technical experts to put together these investments plans and implement them. And I think that is a major impediment that we in Europe have to start thinking about much more consequentially and what to do about it. So what can EIB do? Debora and Vice President Czerwinska already mentioned that we are transforming ourselves to become the EU climate bank. So one thing we can do is to be the harbinger, the pathfinder in terms of climate, and bring the policies and the regulatory framework closer to our clients, help them, accompany them in their transition, also introducing the high standards and transparency that would be needed in order to move forward with the investments. And so what else? Lending, blending, and advising. So financing is, of course, something that we can bring to our clients. It's not only that we have developed green products such as green loans. Our participation in the green bond market has helped to develop the green capital markets in Europe and globally. But of course, we use our whole product palette to support and complement financings of green assets, from venture debt and more sort of thematic, first-of-a-kind projects to senior debt financing and project financing transactions. So we are trying to cover all the layers of the capital structures in the green projects and be complementary, crowd-in private sector participants. Then blending. I think EIB is in a very unique position in bridging public and private, and we can, with our blended financial instruments, provide de-risking capacities in particular, and leverage on those scarce public resources, and try to finance and indeed invest in those more risky step change projects, and pave the way also for the private capital to then flow in. And then finally, we shouldn't be forgetting advising. I think it is very clear that in order to accelerate the investment in green, capacities need to be built in the banking sector, in the financing sector, as well as amongst the companies and public sector entities. And there, the bank can also help. We are more and more combining our financing offer with our advisory offer, and pivoting our advice and technical assistance towards green. So blending and advising, and I'll stop there. Thank you.
Part of this panel. So far we've been focusing on the firms, but of course the transition will not be possible without proper government support and fiscal policy, and with that I'm turning to Daniel. The exceptional events of the last couple of years, including the pandemics, have led to substantial debt increases of the governments. At the same time, the governments are faced with the need to step in to compensate for the energy crisis, for the climate risk and so on, and dealing with the consequences of natural disasters like the floods in the case of Slovenia. So how do you see to what extent this climate risk is relevant for the sovereign debt sustainability, and in turn the ability to design proper policies supporting the green transition forward? And given the time horizon issue that we face when policy making, so how should the governments then navigate between the short-term and long-term challenges in managing orderly transition?
Yes, thank you. And first of all, many thanks to the Banka Slovenije for inviting me to this panel of great experts and good speakers. I always take every opportunity to come to Ljubljana, one of my favorite cities. But in the substance, it's true that there's been a big rise in government debt in absolute terms and relative to GDP. I think really starting from dealing with the global financial crisis and the bank bailouts then there's COVID, another shock. As mentioned, there's the energy crisis, and in some cases dealing with natural catastrophes, some countries. But this comes in the context of rather low trend growth, even low nominal growth for quite a while since 2012 or so, and also quite a bit of demographic strains coming from an aging population, more need for pensions, care for the elderly, which I think is the biggest fiscal challenge going forward. So to answer the question directly, yes, climate change risks is very relevant to sovereign debt sustainability, and especially so in smaller countries and emerging market countries and some of the countries in Central Eastern and Southeast Europe. So there are above-the-line effects of higher expenditures, first of all, for investments, for transition and adaptation, as mentioned, but also, importantly, to compensate those who lose out in this process. And there are a lot of them, and of course, everyone claims to be, need compensation. Rural areas, brown industry workers, people who have oil-fired furnaces in their homes. A lot of people need compensation. There's a big expenditure demand there. And then the natural catastrophe repair costs, and that's been sort of socialized, those burdens. But there's also revenue side effects, as there are maybe stranded assets and also declines in certain traditional industries, not just because of transition, because of technological change. I mean, electric cars apparently need much less repair and are simpler to build in some ways. There's been a big change to the European automobile industry. Also, chronic climate change affects industries, particularly in countries say where the agriculture is important or where forestry is important. I mean, I live in Austria. It turns out that wood processing is quite an important industry, and drought causes more bark beetles which kill the trees. So the government is large, so it's not just a fiscal effect, but there's a macro effect overall. For example, if you start investing more, unless you save more, the balance of payments is going to deteriorate. There's going to be more foreign financing. That's one of the considerations going forward in terms of vulnerabilities. You should contain those vulnerabilities. Likewise, the effects below the line as financial markets anticipate possible higher exposures and leading to higher funding costs and making precisely the needed investments more expensive. And indeed, there's already some evidence of financial markets pricing in some of these risks, charging more for countries and also corporates seem to be more exposed to some of these transition or physical risks. In some ways, this is a good thing. This is what we want. This is what the market discipline is meant to take place, where, if you don't act in a forward-looking way, you will be penalized. There's certainly also concern, which I share, that we're going to have a Minsky moment when markets suddenly wake up to just how severe these risks are, and the risk premium go from being quite moderate to being quite high in a matter of days. And this could be at the sovereign level, but it could also be at the regional level. I'm thinking that maybe something like California is very exposed to drought and other natural disasters. So far, not much given attention, but it could happen a lot. It could happen to parts of European countries, southern Spain, for example. So there's a risk of a vicious circle where even though the large investment needs, the sovereign debt sustainability gets into question, there's higher funding costs, and therefore there's less investment taking place, and perhaps political pressure to do more short-term policies. However, as was mentioned also by Mr. Vosner, there's also upside risks. You could have a virtuous circle. There are countries which would benefit from a smooth and fast transition, particularly countries which are hydrocarbon importers now. I'd cite, for example, a recent report by the Hungarian National Bank, which suggested Hungary might actually do quite well in transition. And maybe Slovenia also, and Austria, and so maybe quite a few here. So in that case, you may become the safe haven country and benefit by lower funding costs, and also, by the way, coming back to natural disasters, a lot of the transition involves reducing exposure to natural risks by more diversified systems, actually more robust. So the answer is yes, it's important. If it's done right, there's some good prospects, but it could also go severely wrong and become precious. I've been told to discuss a bit balancing short-term and long-term risks and policies. I've also been told to keep my answers short, which is good because I don't have a brilliant, concise answer to this question. One thing is that it's very difficult for the sovereign to bind its hands and have long-term commitment. And this time and consistency problem, as economists call it, is severe. Just some sort of financial engineering is not going to solve this problem. But the two things which I think which I would emphasize here. One is that one needs to think about policies which focus on a wide-based benefits and sort of maintain consensus by having sort of salient good things for many people. I'm thinking, for example, in some countries now have much cheaper public transport. People really like this, and you help build consensus to make it happen. Some countries, even Luxembourg, I believe, this public transport now free. Okay. The other thing, which is a subtle point perhaps, but I think quite important, is that debate which authorities can do is to embed a low rate of time discount in financial planning. When you're talking about public sector investments, your rate of interest, it turns out, is not 4% or 3%, but maybe like 0 or 1%. There was this debate more than 10 years ago about what is the interest rate which applies. But clearly, the real rate of interest has declined over trend over recent years. This makes a big difference to what's viable and to what makes sense for the public sector to invest in for returns over not 10 years, but 50 years. And that's what it's going to take. So I'll leave it at that.
Thank you, Daniel. Very interesting, so also encouraging in terms that there are ways how to bridge this time inconsistency problem. But again, probably here the communication, education, this is again the key of people really to understand the benefits of the measures. Of course, the fiscal policy is not the only one that is affected by climate change. Also, the policy space of the monetary policy is been affected via increased volatility of prices. For example, higher food prices recently after the extreme weather events. Also, the more frequent exogenous macroeconomic shocks that obviously impact our mandates of the central banks, which is the price stability. Sandra, turning to you with this question, how does the monetary policy in the euro area take climate change into consideration, and how do you see the contributions of central banks more generally in this transition to our future sustainable economies?
So, thank you, Tina, very much, and I would also like to thank you for inviting me to this conference and to this great place. I share Daniel's admiration for Ljubljana, and I'm always happy to be here with you. So, let me just remind ourselves at the beginning when all of that has started for the central banks. We know that it was only in 2015. Okay, there were some small steps, baby steps before that, but actually it all started in 2015. Then at the end of 2017, the GFS has been created, which was very active, and all the central banks participate from Eurozone participate at the NGFS, and there is where all the development actually started and happened. And I'm following this area for the last 4 or 5 years, and I see a tremendous development. You can see the explosion of knowledge related to climate risks and how they affect not only the monetary policy, but all the areas of central banking. And within only 4 or 5 years, we have developed the language, the tools, the methodologies, the data. Now we are much better with data than at the beginning. So I think that, yes, we are developing at a relatively fast pace. However, there is still very much to do. And the same goes for the Euro system and SEB and all the other central banks. Actually, you probably all know and are aware that ECB is very much dedicated to this issues of climate change, and not only climate change, but also the devastation of the environment, the environmental risks as well. And Euro system has so far incorporated climate considerations in so many areas, almost all areas of its operation, very much in the area of supervision, financial stability, in own operations, And on functioning, however, I would say that in the area of monetary policy and monetary policy implementation framework, even the ECB is still more or less in its infancy. And there are still many things to do, I think. And I would just mention two important documents, two steps in the relatively recent past. The first one is the strategy review of the ECB's monetary policy implementation framework in 2020-2021, and also the climate roadmap, the document that has been published in 2021. And actually those two documents have paved the way for further actions of Eurosystem in the area of monetary policy. And after that, we have seen some development. Our colleagues here have said that in the meantime, we became more active in assessing climate risks in the balance sheets of the Eurosystem, particularly in certain portfolios. So we have bought actually data from two data providers, and we are using those data in order to assess our climate exposure in our portfolios. As far as I have heard from Slovenia, they're actually assessing climate risks in their the whole portfolio of Slovenian Central Bank. For the others, it's only some parts, some portfolios, non-monetary policies primarily. Apart from that, we all know that the ECB started to tilt the purchases of the assets within corporate bond portfolio. However, with the QT, those measures are becoming less powerful than they are meant to be at the beginning. And there are also two other areas that are on the list of climate roadmap of the Eurosystem, and also are related to the collateral framework, actually with requiring collateral climate disclosures for collateral eligibility, and also introducing climate-related measures into the collateral framework. And that is basically what is happening now. Of course, our colleagues in research departments, they have started to figure out how to implement shocks coming from extreme weather events and how they might affect not only the price developments, but also the volatility of prices. They are starting to figure out how they could incorporate climate change into the macroeconomic models, but still there is much to do on that front. And I would just mention that right now the NGFS is again doing a big step, a big leap forward. First, it was scanning the appetite among central banks when it comes to incorporating climate considerations into monetary operations. And it turned out that the majority of central banks is very much concerned about the effects of both physical risk and transition risks on price stability and price developments. So that means that they will probably in the near future try to assess what are the effects of shocks related to physical risks on prices and other macroeconomic variables. And they also think that they should incorporate climate considerations into their lending operations. What we see, as in all other fronts, there is still lack of data, lack of knowledge and understanding. So in central banks, we are mostly economists, so we don't feel very comfortable with this climate issues because they are more related to other sciences, not to economics. But we are making progress already. So the lack of knowledge, the lack of data, and actually the lack of available time and resources, that is something that prevents faster progress in that area. But since we are all concerned and we all see what is happening, with floods in Slovenia and heat waves all over the place and wildfires in Greece, I think that we are all very much motivated to do even more. Of course, we always say that central bankers are not the first line of defense. It's the government and the parliaments who are the first to implement climate policy measures. However, we can do more than we do now.
Thank you, Sandra. As I understand, like other policy areas, also monetary policy is overwhelmed with the challenge and trying to somehow meaningfully incorporate that into the operations. And you mentioned also the network of for greening of the financial system, very important initiative for the central banks. But whatever the policies do, ultimately the financial sector will be the one providing finance. And actually the financial sector can be seen as a catalyst for the green transitions by many. And for that I'm turning now to Patrick. The legislation on the banking supervision and also the newly proposed amendments to it mainly focus on risks, although there are, let's say, there are major steps in that, in assessing and mitigating also the ESG risk. But can we do more directly incentivize banks to increase their engagement in green and transition finance? How do you see the role of supervisors, the ECB on that? Thank you, Patrick.
Thanks, Tina. Yeah, better. Many thanks, Tina. Many thanks for inviting me as well. It's always a pleasure. And yeah, good to see that we have also a perfectly gender balanced panel. Yeah, of course, the mandate of supervisors is risks. And I think we need to remain acutely aware of this. It's not a mandate to direct the financing of the economy from financial institutions. And we also repeatedly say that whatever we do not have outright calls for divestments from brown sectors in particular. What we care about is transition financing, not so much, of course, for the sake of transition, but also because we believe it will be a factor of risk reduction in banks. And this is what we primarily care about as supervisors. We acutely believe that, of course, we are not the only game in town, and we are absolutely delighted to see that our colleagues in central banking are progressing as well on that front. We have to work together with governments, private sector, etc., but we need to play our parts. So we really see us at the forefront of playing our part as banking supervisors in making sure that this is happening. One important topic also, I think this debate has slightly abated, but we had for some time a debate about the dual materiality concept and so on. I'm not, quite frankly, completely always convinced with I think intellectually it's a very interesting debate, but at the end of the day, I think banks have an interest in financing the transition. of course, for the impact on society at large, etc., but also, again, because if they don't do it, it will come back into massive risks in their balance sheets and business model more profoundly. So, again, we see ourselves totally legitimate to go into that direction, and when we issued, you may recall, that when we issued our expectations in November 2020, we took great care of pinpointing each and every of these expectations to current enforceable prudential legislation. So now, in that context, what can we do today? I think we can do essentially four things. First, making sure that climate and environmental risks considerations, we should not forget about environmental risks. It's not only climate, they are heavily interrelated. Should find a way into risk management, governance, risk appetite setting for the banks, and I think this is why you see me and others repeating again and again as a broken record the same stuff everywhere, because we believe it's acutely necessary. Also because it does create this awareness that we all strive for, also with the boards of the banks, and this is where it has to start. The second thing we can do, of course, is help creating market transparency via disclosures, Pillar 3, and so on. Also, more broadly, by encouraging the dissemination of data sources, open data sources. We follow with a lot of interest the developments of the PBD directive, for instance, with probably more disclosures of EPC labels that are crucial to transitioning a huge part of the real estate market in Europe. And of course, by encouraging the development of green bonds and a sound market for green bonds, which also in turn means that we need to be extremely careful about potential greenwashing. This market will not take off if we still have market of perception that people don't really know when they invest, what they invest into when they buy a green bond. And I think that's critical that we collectively make sure that this is progressing as well. The third topic is, of course, stress testing, sensitivity analysis. We have done a few, and we will continue in that path to create further awareness and help all market participants and banks really getting a more informed view about their risks in their balance sheet. And of course, the last thing is that we can work towards gradual incorporation into capital considerations. And we always said that eventually we would go to Pillar 2. I think our Hungarian colleagues have led the way from that perspective, and so this is something that we are, of course, looking into, but probably in consideration with what is future developments for us, and which is transition planning. And I think the one thing I find extremely relevant in the developments that are being discussed right now in terms of prudential supervision and prudential regulation is transition planning, creating an obligation to banks to devise transition plans and to supervisors to review them. And that it will be, of course, a game changer for everyone. And it will be very important that we all start preparing for that. We have a number of topics to discuss with the banking industry. We have started discussing with the banking industry on that point. Of course, the first order question is customer engagement. This is the latest thing we say time and time again. Please engage with your customers. Understand the data, ask for data, understand their strategies, their adaptation strategies, advise them. And by the way, it's not my job, but I do believe there are opportunities from a business perspective in that context. And I think this is something that we see some banks picking up already, and we have examples of banks already embedding these considerations into the front line and the sales, and some are getting pretty efficient. I mean, we start seeing good developments here. So that's extremely important. And also, I think thinking about what corporates in particular and the customer base have to do to progress. We have started looking a little bit more into this topic. Maybe we will publish something towards the end of the year, looking at PACTA information in particular, and we see that if you focus on the 6 sectors that are most relevant for the transition for non-financial corporates, and there are not so many, in fact, that have a very huge impact, and we see that we have more or less than 10% of total NFC exposures of the European banking sector that are on 6 key transition sectors that are deemed to represent more than 50% of the CO2 emissions overall. So really focusing on these 6 transition sectors: oil and gas, cement, I'm sure I will forget some, automotive, power, and so on, is the first critical step. And for this, both customers and banks really need to think about 3 topics in terms of transition planning: decarbonization, build-up of alternative production methods, but also phase out of existing production methods that do require financing. This is very often forgotten, but this does require financing as well, and it is absolutely critical because historically at global level, I'm not talking about European level, but more global level, we have, as a species, we have always piled up the energy sources. So despite what we might believe, coal consumption has not decreased. We just have piled up energy sources on top of other energy sources in an ever-increasing energy consumption trend that is, by the way, remarkably correlated with GDP growth curves, just food for thought. So that is something we will really need to focus our mind and the mind of the banks to, if we want to succeed collectively in putting together these transition plans.
Thank you, Patrick. Thank you also for, let's say, providing food for thought outside of just this very narrow scope, but somebody maybe associate with the strict rule of the supervisor, and by highlighting that really the game changer are the transition plans. I think this is the homework for every company, financial company, for firms, for everybody. And the other thing you mentioned is also the change in the capital requirements. We will see when this will come due, but I understand that this will also make a significant change. But with that, let me turn now to the banking sector view, to Alenka. So you have been very active in providing green financing. NLB has also issued a green bond. So how do you find this, where and how do you channel these funds to? Do you find, are there enough projects out to meet this, the funding supply that you have? And how do you, what are your incentives actually to engage in this financing? Thank you.
Thank you very much for the question, Tina. Good morning, everybody. First of all, I would like to thank Banka Slovenije for inviting us to this panel. It's no doubt an honor to share the stage with such esteemed speakers and experts. Usually, I tend to take a couple of minutes to tell something to the audience, something about the NLB, but in this context, I believe that we don't need this introduction. NLB is universal bank under direct supervision of ECB. We are NFRD compliant. We are navigating lately the maze of CSRD and ESRS. It's super exciting challenge. And what I would really like to point out is that I'm glad to say that NLB decided to join UNEP-FI. It was at the beginning of 2020. We became a signatory to principles of responsible banking, and this decision is now shaping our strategy and our tactics. In the year 2022, we also decided to join even more ambitious initiative, and we were the first bank in Slovenia to do so. It is called NZBA, so Net Zero Banking Alliance, which basically means that now we are in a process of preparing a net zero strategy, a very comprehensive net zero strategy, by diving into these topics. You know, each month we open additional topics related to this challenge. So I believe that in the year 2024 we will definitely come up with a comprehensive climate strategy, which will cover operational part and also the portfolio part. And as you all know, operational part is not a problem. The portfolio part is much more challenging. But now if I go to your questions, NLB successfully appeared on the international financial markets in June, this time with the issuance of our inaugural Green Senior Preferred 4 and SIF3 notes, basically green bonds, in the benchmark size of 500 million euros. This bond will definitely align on a best efforts basis with both the EU taxonomy, technical screening criteria, and minimum social safeguards, which confirms a substantial contribution to EU environmental goals. These funds particularly will be used in the area where we are present, so in the Balkan region. We will finance existing and future project-specific loans. It will be used to support projects in the field of renewable energy, energy efficiency, green buildings, clean transport, sustainable water, wastewater management, and pollution prevention and control. These notes are also intended to meet MREL requirements and also future growth opportunities. You also asked me if there are enough suitable projects available to meet the supply of green and transition financing. Well, of course, we analyzed and we are analyzing our markets pretty into details. We understand now that all countries, I'm talking about the Balkan region, of course, have now national energy and climate goals. We expect that companies, so legal entities, will invest around 1/5 of their investments to the green transition in the following years, which actually translates to around 3% of their national GDPs. Highest investments are expected in renewable energy sources, green transport, energy efficiency, and low energy buildings and green buildings. The highest investments for sure will be made in Slovenia, Serbia, and North Macedonia. We're, of course, as all other banks, dealing with a big data problems, so which were already mentioned by colleagues before. Let's say EPCs are basically not available in some countries that are not in the EU. Let's say for Kosovo, we cannot, I mean, if we want to achieve decarbonization of our mortgage portfolio, this is pretty hard to do because, first of all, we don't even know where we stand. So yeah, EPCs would be really important for us. Of course, the dynamics of investments will depend on the financial capabilities of economies. These economies are, of course, economies where ESG is not very high on the agenda still. We're seeing this consistently. We're doing as much as we can to raise awareness. This is also one of our missions in this part of the world. But what I can assure is that in the year 2024 and in this year as well, NLB Group will finance renewable energy sources, energy efficiency, low energy buildings, and in the next 5-year period, this distribution will be around 75% in renewable energy sources, and then 12% into energy efficiency and 5% into low energy buildings. And now to the last question, where do banks find incentives to participate in green finance? I would rather talk about motivation, not incentives, because there's not much of them, honestly. Yeah, I mean, we issued a green bond basically not because of, yeah, incentives, financial incentives, but the most important is to enter the market. I mean, we are committed, publicly committed to help the region in their transition to low carbon economy. So we want to position aggressively in this sector. And I would also like to point out that our shareholders are super pushy, I must say, and in a good way. And their expectations are extremely high, and there is no intervention from the investor that would not address ESG in the first 2 or 3 questions.
Thank you, Alenka. So the market is doing its way, as we heard from Daniel, that eventually our role is to advise, to engage, and then the markets will hopefully support the transition going ahead. Let me now go to the second round of questions, in which I would like to focus a little bit more on the collaboration between the various stakeholders and policies. What we see, namely, is that the engagement or the actions are really scattered across different institutions, policymakers, private, public sector. They also very much vary across the country. So even in Europe, we see that despite that we have the EU, we see really different level of commitments by the national governments, and also different progress made so far in the transition to the low carbon economies. Peter, again to you, where does Slovenia stand in that respect, and what should be the appropriate EU-wide and national strategy to close the gaps among the countries? And we heard from Debora this morning already, probably it's better to be choosy, to be targeted, than to have these national, very broad strategies. But I give it to you. Thank you.
Thank you very much. If I may start with how we're doing and make a little joke, even though this is perhaps not the most jokey-like environment. I would say, it seems all good, on the sunny side of the Alps, perhaps too good. And the reason why I'm saying is that because from environmental perspective, sustainability perspective, we are trailing. That's the word I would use. Now, before explaining what I mean with trailing, let me say why I think that's a problem. Well, because the figures that I was mentioning before, both on micro and macro level, they are true on average. But I would argue that it's with sustainability transition, it's exactly the same as with digital transition. The leaders will gain, will benefit. I won't say that the laggards will lose, but they will certainly benefit much less. Although I would be inclined to say that they might actually lose out. So I think that's a serious risk for a country like this in particular. So that's why I will argue for a much more ambitious strategy or take that we should be kind of after. Why am I saying that we're trailing? Well, if you look at Eco-Innovation Index of the European Commission, we're approximately 5% behind the EU average. We are better doing on inputs and worse on outputs. So if I go to issues that were mentioned before, for example, energy productivity or emissions productivity, we're trailing in the range of 10% behind the EU. And that, you know, in that context, you know, the very fact that we're looking at where we are towards the average of the EU makes me a bit, you know, it's for the last 4 years that I'm editing the productivity report, you know, I'm trying to argue, you know, we should be looking at the leaders. And there, of course, the gaps widen. So, for example, you know, circular material use, we are, you know, in the range, in the order of ×3 behind the Netherlands, which is the leading country. If we look our gap to leaders in energy or efficiency or emissions productivity, you know, it's ×2 that we should be the context in which we should be designing our strategies. Now, I don't want to sound all negative. There are signs which are positive. Since 2022, the awareness seems to have shot up significantly. And more importantly, investment seems to be starting to pick up, finally. At least as far as planning is concerned. So that is probably a reason for optimism, which I think is really good. Furthermore, even on the public side, for example, we are seeing some movement, for example, increased investment in research and development. Though I have to add immediately, you know, it's not as rosy as generally perceived. We are going in the right direction, true, but so are other countries. You know, one reason is, of course, European funding, but you know, we should not forget this is a competition. So it's not just that we are improving ourselves in absolute. We should be improving ourselves also in relative. So what does that mean for policy? For policy, you know, and here I should perhaps, you know, make a disclaimer. It's more of my view rather than my institutions. You know, in one sentence, I would say that policy too, as I was saying before, for the corporate sector, is too reactive, is too traditional. We are, you know, things that we're familiar with, infrastructures, preconditions, etc. Fine, we're you know, that's something we're comfortable with. This is something that is in front, considered as a priority. But things that, you know, to try out new things, to innovate, consider that, you know, there is a real benefit if we are the first. You know, the first mover advantage, for example, is something we've been trying to really push for the companies to consider. Of course, it's more risky, and you know, you as a financing sector should consider that too. But there is, you know, there is the flip side of it. You know, there is benefit to it. So I'm trying to say, and perhaps just a comment before to Mr. Hardy, it made me think, you know, before, I'm just a bit sometimes afraid that we will entangle ourselves in this compensation debate. You know, sure, you know, just transition, all good. But, you know, before you come through with all this, who is, you know, who will be hit worst and how much they should be fairly compensated, et cetera, et cetera, et cetera, you know, sometimes, you know, I really wonder, you know, and here, you know, pace is not our kind of, you know, it's not our strength. So it's perhaps something to consider as well, you know, this to really make this transition as fast as possible, to focus on value creation, getting inspiration from the digital side, which really, you know, if you look at the literature of the last couple of months, you know, the generative artificial intelligence, what companies are doing on that front, you know, two things. One, training, two, investment. And that's something that perhaps, you know, we should kind of, that should be our kind of really the line we should be following. Now, in terms of what does that mean for policy, you know, I've been in policy-making world for 20 years, so I know what I'm saying is very easy to say and much harder to implement. That said, you've mentioned whether sometimes I'm afraid, especially from institutions like in this here right now. You know, we have data on the level of sectors, sure. But that doesn't mean that the government should pursue the sectoral approach. I mean, I would be really careful on that front. Sure, we don't have other kind of data. That is how statistics are structured. But that's not how neither the markets work nor how firms interact. That's why, but at the same time, of course, the government policy, I would argue, need to become much more responsive and much more adapted to the specific needs of different parts of the economy. That's why I think it's paramount that you know, we get reorganized in the way how the whole transition planning, if you want, if I may use your expression, is done. And in my view, for example, what Slovenia has been doing with regard to, for example, smart specialization, that to me would be the right kind of organization in order to address challenges and in particular opportunities. Now, why am I saying that? Because frankly, I'm really optimistic as regards things that, for example, the corporate sector will need to do. As long as it is something which falls within the merit of an individual firm. You know, looking at the historical performance, we tend to be somewhat late, but once we wake up, we tend to be faster than the rest. So things that will fall within the remit of a particular individual firm, I'm not worried. But the problem with green transition is that there is only so much an individual firm can do. That's why individual companies' investment decisions are co-determined by investment decisions of the others. And this is on the level of firm. This is on the level of national level, regional public authorities, corporate sector, and between the national and international / EU level. And that's why, I would strongly, and that I think is really the heart of the challenge for green transition, because it requires reorganization. And two, you need to set yourself priorities, and on that basis you need to make choices. And choices is something we are not particularly fond of doing. I participated in one event where our national energy and climate plan was being discussed. Very credible presentation, I have to say, convincing. But then the discussion started. Question number 1, how about this? And the answer, yes, that's important too. Question number 2, how about this? The answer, yes, that's important too. And every question that came, everything was important. And that was, it was a bad signal, because, if everything is important, then, it doesn't really, it doesn't give you the base for collective action. And that's where I think we'll need to be, that's where I think we'll need to kind of really start again, as I said before, as on the corporate level, also this collective kind of strategy design will need to be much more upgraded. And by the way, that is also, I would say, a door opener for stronger international integration, even if we look not from an environmental and sustainable perspective, but purely from competitiveness perspective. Once you get organized, it's so much easier, you're so much more credible, and so much more easier to get closer to, for example, the early stage of R&D development with the key players in Europe, which I would argue is a key for economy like ours.
Thank you, Peter. So it seems that there is quite some challenges on that front, how to create this environment that would be conducive to this innovation, to the different approach to this, and maybe we can learn something from the digital transformation also for the climate. But as we heard, I mean, they go hand in hand, but it seems that that the digital was, let's say, easier to have been implemented because we were forced to, because of the pandemic. Let me go back now to the investment, to the financing perspective, and let me turn now to Elina. The regulation and public policies, as you find in your investment report, are important levers for green transition and for directing private financial flows to low carbon investments. Yet, despite ambitious regulatory actions and policy targets, private sector investment continues to lag behind the public efforts. And the current economic climate, as you outlined before, may further negatively impact these private investment policies going ahead. You touched briefly upon these blended financing initiatives in the past, but maybe more generally, how could closer public and private sector collaboration help to close this investment gap that we hear a lot about? Thank you.
playing more pertinent role, which is the renewable energy and notably the offshore wind, and more recently the EV battery value chain. In other areas, more often than not, the private sector is still shying away, especially when it comes to investing in new technologies and financing that scale up the step change in these sectors. And now, why public-private partnership in this context is really important. Again, maybe looping back to the offshore wind sector and the batteries, and reflecting on that question through the lessons we have learned in the development in these areas. So first, large public investments indeed, including concessional financing, was needed to kickstart the development in these sectors. And we needed smart incentive schemes and conducive regulation, including the feed-in tariff framework, etc., to really entice the investment. And then through this creating the conducive investment climate through regulation and public interventions, the private sector ultimately felt more comfortable with the risk and engaged. And in between, the international financial institutions and development agencies such as EIB were there to provide financial instruments for de-risking, leveraging on the public resources and bridging that valley of death, if you will, between the public funding and the private. And I think we need this kind of pathway also in other low carbon sectors and industries. For example, the hydrogen or the more transformative energy efficiency related investments. What can then EIB or public banks do in this regard? How can we facilitate that closer partnership between public and private? I already mentioned that banks like EIB can, of course, be the pathfinder and promoter of the existing regulation, bringing, for example, the taxonomy to the market, improving the transparency, which is very important for private investors to engage. But I think the de-risking indeed is the buzzword here. We can be the lever or the bridge between the public and private. Use those, take those public resources that are scarce, develop financial instruments that are then allowing de-risking of these more transformative projects, helping to bring life these lighthouse projects, demonstration projects, and supporting the capital structures of those more the scale-up investments when you want to bring demonstrated technologies to more commercialization, to the commercialization phase. So I think that is the key role that the public banks can play. So we are working very closely with the European Commission and the EU member states. We have quite strong track record in that leveraging and de-risking. Under the investment fund for the EU Fund for Strategic Investment, EFSI as we called it, EIB actually mobilized some 500 billion of investment over the EFSI period, and 2/3 of this mobilized financing actually came from private sector. So we have good track record in deleveraging, and we are aiming to do the same under the InvestEU now over the next programming period under the 2027. And it's about de-risking alongside with the provision of liquidity and bringing the public and private closer together, also facilitating the dialogue between the policymakers and the real economy upstream, bringing the policies and the regulation closer to the real sector, helping to translate. And then finally, I cannot emphasize enough, and also there, I think EIB can play, and public financial institutions can play a key role, is the capacity building, the knowledge sharing, and building those capacities, relying on, like us, on the EU Commission to fund and help us to do that, and help to mainstream climate considerations also in the private sector. I'll stop there.
Thank you, Elina. We hear that the EIB has an important role in this respect, so we can rely in the future also on that partnership. With a similar question, I would like to continue with Daniel. So this interaction between the government and private sector in providing funding is very important. We heard also about this blended finance initiatives. What is your view on that, and how that should be best explored going ahead? Thank you.
As mentioned repeatedly, there do seem to be many good investment opportunities, particularly in seeing the long-term payoff. And so how do you get the funding necessary to get those going? And blended financing certainly has an appeal in terms of generating leverage on limited capital, and also diversifying risks, so those people who bear the risk are best able to bear them different ways. However, I should have a note of caution at the beginning, because I think international experience with PPPs has been quite mixed. Some countries are much better than others, if you look around the world over time. And I think the fundamental level is that there's certain tensions involved, because the private sector have certain informational advantages over the technology, over the commercial risks, where the public sector is kind of a monopsonist position, and also gets to sort of set the rules, and also the long-term perspective. And so because of these different abilities and different incentives, there can be tensions and conflicts, and sometimes things go badly wrong for one side or the other, and even a slight element of sort of wariness one side or the other. I should also say, if you do this on a big scale, there are implications for sovereign asset liability management, because the government acquires different sorts of liabilities, but also different sorts of assets in this process, which ideally they should consider in their asset liability management overall. And I see my friend Mariam in the back there, who's a Slovenian debt manager, is very aware of these issues. So clearly there are some projects well suited to the private sector financing, provided that there's a stable policy environment. And I think you mentioned this a bit. Policy risks are a big deal, discouraging private investment. One sees this in lots of different countries. Even Germany was a leader with wind turbines, and they changed the rules that basically made it difficult to install a wind turbine closer than 2 kilometers from a settlement. Germany is a densely populated country. There are very few places not 2 kilometers from a settlement. So you can kill something by these regulatory changes quite rapidly. But it can work. I think many areas like real estate insulation, in principle, is very open to private sector financing if you have a stable environment. There are other things clearly suited to the public sector, particularly when the externality involved, the benefit is very widespread and difficult to capture, when the benefits are over the very long term, and also when much of the benefit consists of avoiding harm rather than generating cash flow. And I think a lot of the adaptation measures have this property. And I was thinking about this actually here. I know that in the backside of the castle here, there's a canal, I think it's called the Gruber Canal, built like 200 years ago originally to divert water from downtown Ljubljana. As far as I know, this is a public investment which has paid off very well over hundreds of years. I don't think you get private investment to build a canal on the backside of the Ljubljana castle. And there's similar things in other countries. In Vienna, there's a Donauinsel, which has the same similar function, and in London, the Thames Barrier. So having said there are some things we're just going to need the public money, this sort. So what may be more suited is that's when the government can take on some political and long-term risks and the private sector can take on the more technical and commercial risks. But then, of course, you need to somehow embed this in a contract. It's not going to be constantly renegotiated and open to abuse one way or the other. And that's a very tricky thing where, indeed, the IFIs have a lot of experience. They can help national authorities design these sort of arrangements, that they have the right incentives in place for everybody to keep them going. And sort of areas which might work. One, there's some elements of the transition and adaptation infrastructure. Besides those mentioned by Lena, I think, for example, a lot of the energy grid has potential for this. It's a big deal, constructing the pylons or the pipelines for hydrogen, whatever it is, involving public and private money. And I think that maybe some area like energy storage is also a big challenge, might be suited to this. I'm not an engineer, so I'm a bit sort of basing this on intuition. And I think something which was a bit mentioned here, but very important, is also R&D. A topic which much of the news recently in the survival industrial policy, but where the government has an important role to do certain fundamental research and set it up in the private sector, then commercialize it. I'm thinking, well, maybe this energy storage, but maybe also like removing methane from the atmosphere, which I understand is relatively easy compared to removing carbon dioxide. But it could be a big deal. This is a third of greenhouse gases is methane and nitrous oxide. But I would like to end with another priority, not I think enough mentioned, namely the role of blended financing internationally. IFIs, of course, EIB, World Bank, etc., but also perhaps bilaterally. If we're going to really go to transition to a zero carbon economy, this means a lot of change in the emerging markets and developing countries. That is where the coal plants are still being built, and that's where coal is still being burnt. And this is not a charity for advanced economies. They would have some return on this investment, and the payoff would be in reduced transition risks and physical risks in those countries, which also has an important geopolitical benefit, I think. So it really is in the interests of the advanced economies to try and introduce some way of sort of like producing some sort of first tranche financing for the emerging market countries, developing countries, to help with their transition. And that is where the low-hanging fruit now is. So I'll leave it at that.
Thank you, Daniel. Food for thought. So you put a light also on the global cooperation or the issue of the global burden sharing of the green transition, and also low-hanging fruits. And we heard from Alenka before, you are active regionally, so actually overstepping the borders would sometimes be also an opportunity, but indeed we will all faced with that challenge to contribute to it. When it comes to monetary and supervisory policies, let me turn now again to this field, we have also seen that the central banks and supervisory authorities have been actively to the different degrees across the globe. And Patrick, turning to you, the ECB has been one of very active central banks in addressing the climate change on the supervisory front by supporting orderly transition, ensuring the banks are adequately prepared. We heard previously about your activities. And so how do you assess the progress made by the banks in the euro area so far? And on that, let me ask a bit more specific question that came to my mind after these devastating floods in Slovenia that, of course, nobody could have ever expected or even think of. So are the banks prepared enough for such extreme events like these? And there is also another issue that comes often to our minds when we talk about the supervisory expectations in Slovenia, the proportionality of that, because we have smaller banks. How do you address that? Thank you.
Many thanks, Tina. Maybe let me start, if I may, because I think it's a very important component, in fact, of our discussions. You started by saying nobody could have expected the unprecedented magnitude of the events we saw. Actually, it was expected. It's in climate models since 30 years. But I mean, we'll look at all IPCC reports. I mean, it's the methodology is refining over time. as they get more data, etc., which, by the way, all signal that the rate of change is going way beyond what they have modeled so far. So I think it is in the models. It is expected. We don't know when, where, at which magnitude, but we know it's coming. And we are only at 1.2 degrees so far. I think I'm very often mentioning this, but just I can resist mentioning it again. It is estimated that the difference between 1850, before the start of the industrial era, and the Ice Age 10,000 years before, there is a difference in world average temperatures of 5 degrees. So we single-handedly, as a species, managed to move the temperature by 1.2 degrees in less than 2 centuries. So who said that humankind could not terraform planets? So this is, I think this is something that is extremely important because it's, I think, speaks to our psychology. To start acting, we need to be hit. And this leads me to one of the difficulties we have with banks and also with supervision and I suppose a little bit monetary policy is that we have a lot of models, supervisory models, macroeconomic models to some extent as well that are built on normal distribution laws, you know. This nice curve we have. And I'm not completely convinced that climate is on that type of curve, obviously. It's a S-curve, it's exponential, and it's going to hit us more and more as time passes. And we see the macroeconomic models, when we do a stress test, we have a shock in year 1, and then everything goes back nicely towards equilibrium in the next 2 years. Are we completely sure that this is what will happen with physical risk? I would doubt it personally. And so this is, I think, one of the biggest things we need to collectively think of. This makes the incorporation, for instance, of climate-related events into Pillar 1 models a little bit more difficult because we really need to start thinking very long-term, very exponential impacts that are not completely embedded in our Pillar 1 models, let's be clear. I think the challenge is also as large for macroeconomic models and for banks as well. I mean, this is a big issue. So I think this question of awareness, understanding the magnitude of events and the exponential nature of these events is a big determinant for banks to start moving. So that being said, we see that banks have actually started progressing. We keep, of course, saying that the glass is only half empty, and is still more than half empty. We need to see more progress, etc. I think we still need to see more progress, but we see progress. We see that now the vast majority of banks have minimum policies in place in many different fronts. You are probably aware that at the end of our thematic review and stress test last year, we issued a number of letters to banks asking them to fully implement our expectations into their systems and governance frameworks by the end of 2024, with 3 waves basically of expectations. March 23 for materiality assessment, and 23, and then end 24 for the most difficult topics. And we said we would enforce, and actually we are. Currently, and I think this is really in a bit...
Internalize them much more and take them into account. The question is how much they are really in the business models and in the risks. Turning now to the monetary policy as a perspective, recently we have been talking and reading a lot about monetary fiscal interactions and in combating inflation. And in analogy, how do you see this interaction between the monetary policy and the governments in combating climate change. I mean, as you mentioned before, obviously the government here is, let's say, the first line of defense, but nevertheless, maybe some views on that also from your own central bank perspective.
Thank you, Tina, for that question. As I said previously, governments have a primary responsibility to act on this climate agenda. However, it is very easy to say that, but it's much more complicated with the implementation. Because as we all know, elected politicians have relatively short horizons, and climate policy is not the most popular policy there is, so most of the politicians still bet that the climate risks would not materialize within their mandate, so they will happen sometime in the future. And not only that, but also the politicians and the governments are faced with the so-called climate trilemma, because they have to deliver on climate goals. But if they, for example, select the public investment as a primary tool to deliver on climate goals, that might confront with the principle of fiscal sustainability. So they should not rely only on public investment, but also apply other measures like regulation and taxes, carbon taxes, and so on. But if they implemented those measures, that might be politically unfeasible. So they are circling in that triangle, and it is quite difficult for them to formulate an appropriate policy mix that would strike this sensitive balance between climate goals and political feasibility and fiscal sustainability. So in my view, the governments need all kinds of support in that. And we as central bankers, as I said, we are not the first line of defense when it comes to the climate action. However, we can support in different ways, like through knowledge sharing, information sharing, data sharing. That is the first step that comes to our minds. The second one is that we can use the stages that we have. We, as central bankers, we are always invited by the media, so we can use this, we can be vocal, we can use this public stage and talk about the importance of climate policy measures, and that they should be implemented as soon as possible. And the third thing, I think that we should at least try to coordinate our measures, not only to collaborate, but to coordinate our measures. I know that coordination between fiscal and monetary policy was quite fashionable when I was a student or a young assistant at the institute. However, we don't see much of that coordination nowadays, but there should be the coordination, because if, for example, the governments rely on public investment as a primary tool to address climate goals, that might increase the natural rate of interest, and we might react on that with higher interest rates. And that again has the impact on both private, but also the public investment, on fiscal sustainability and things like that. So we together should find and design the policy measures that are the most effective when it comes to climate change. And we also share the responsibility with the government for financial stability. And on that front, we should collaborate as well. And what comes to my mind, for example, in case of Croatia, you know that there are these climate policy sensitive sectors, or climate policy relevant sectors. Those are the ones that are the most, or could be the mostly hit by transition policies, by the government. In Croatia, for example, we have this huge importance of tourism, And if something happens in tourism, in this segment of the economy, it will surely have the impact on financial stability. So in my view, we should coordinate policies with the government when it comes to tourism. And we should perhaps also open the eyes of the politicians about this climate sensitivity of tourism on which we rely that much. The other area also related to financial stability is the state of our real estate in Croatia. We know that housing loans make a big proportion of all the loans, and in Croatia, you know, we have this. We are genuinely averse towards facades. You know, when you travel through Croatia, you see many buildings without facades, with very poor isolation. That is also not very good from the point of view of financial stability, because the buildings, the houses that are poorly isolated are very bad collateral, and this might also affect the financial stability. So in that area, we should and could collaborate with the government. So we should pick the fronts on which we which are important, which are related to climate goals, and where we should maybe do much more through collaboration and coordination of our policies.
Thank you, Sandra, for this. Now we have come to the end, the last question. We have also exhausted our time envisaged more or less for the panel discussion, but let me finish with a question also picking up on the floods experience recently in Slovenia. So how do you see that from the banking perspective as a game changer in terms of more opportunities for the bank to engage in the green transition or supporting the green transition?
Thank you very much. Well, my answer will be really quick, because really a lot of super interesting things were already said, and we have a lot of things to digest. But when catastrophes like these floods in Slovenia happen, then people need quick reactions. And people don't need regulation at that moment. They don't need bureaucracy at that moment. You have to act really quickly. So like in the time of the COVID crisis, NLB has responded super quickly. We introduced more favorable loans for households, companies that suffered damage. They were not charged the costs of loan approval or the costs of a possible change in credit conditions during the repayment period. We introduced postponement of the repayment of credit obligations without additional costs, then the possibility of free early release of deposits and so on. But what I would like to point out is that banks are not responsible in these cases. We are catalyzers. We can help in green transition, but in a society we should not be perceived as those who, the stakeholder which is responsible to take the whole society through this transition. So yeah, blended finance, we believe that it's going to be the name of the game. And yeah, of course, the exposure and relevance of projects must always be considered in every bank. So for sure, all of these things that happen and are happening because of obvious climate change is the possibility for a bank to step up.
Thank you very much, and thank you for everybody for this panel discussion. I would still like to leave a couple of minutes for questions to the audience. If you could please introduce yourself and indicate to whom you direct the question. I'm sure with these 6 distinguished panelists that you may have some questions. Let us use a couple of 5-6 minutes for this. There are also microphones in the room.
Hi, this is Dejan Golub from Banka Slovenije. I have two questions, if I may. First one is for the EIB representative. You've mentioned during your talk that you've issued several green bonds already. As I understand, those are under ICMA's green bond standard, and I was just wondering whether you plan to issue also under the new EU green bond standard, which should become like a gold standard going forward. And the other question is for the Vice Governor of the Croatian Central Bank. Reading your annual report, I've noticed that you have more than 20 billion of net international reserves, and I was just wondering whether there are any plans to decarbonize that portfolio going forward. Thank you.
Yes, thank you for the question. Yes, our ambition is to converge towards the EU green bond standard when it comes to issuance of our green bonds. We are currently developing the framework of the alignment with the EU taxonomy. We are already compliant when it comes to our green portfolio, so project portfolio that is supporting our green bond issuances with the substantial contribution criteria. And now, together with our clients, we are developing the pathway to also comply over time with the do no significant harm principle and the minimum social safeguards. So indeed, just to sum up, we are developing the framework to allow us in the future indeed to issue bonds under the emerging EU green bond standard.
Thank you very much. So you have mentioned our international reserves. Actually, this 20 billion is not international reserves anymore. Only a small part, which is denominated in US dollars and SDRs, is international reserves, and the rest is financial assets or non-monetary portfolio of Croatian Central Bank. However, we still manage with this quite abundant amount of funds in Croatia. And actually we have started to invest in ESG bonds several years ago. At the beginning it was, those were relatively small amounts, and now it is approximately the same share of ESG bonds in our portfolio like in Slovenia at 7.5%, trending towards 10%. So we have more or less the same ambition as our Slovenian colleagues. Thank you.
Thank you. We have time for one more question from the audience, if there is one. Okay. There are, okay, please.
Thank you very much. A very good panel. I was just missing one person here, representative of EBA. It's a question directed to the ECB. How do you see future kind of development on the regulation? Are we going in the same manner as we have kind of said, okay, we are not going to invest into tobacco? Are we going to try to kind of impose through regulation and demand more as a regulator that the banks should not be investing into a particular whatever area? Or we would just follow what NLB is doing, in the sense of that they do kind of voluntarily go and invest into what might be the winner technologies.
Yeah. So I think that there will be, of course, further developments in terms of regulation. I think undoubtedly in the realm of disclosures, I think this is still progressing. In the realm of Pillar 1 methodologies, this will progress, but in my view, a little bit more slowly for the reasons I mentioned earlier. I think there is a huge framework discussion to be had on this, so that makes the discussion a bit slower. And I think we will continue seeing movement in terms of Pillar 2. and in terms of transition planning, but I do not believe that anyone would start directing banks to say you need to invest X percent in that sector and Y percent in this sector. I don't think this is the role of supervisors and regulators, and I'm not sure how we would do it and how we would be wiser than anyone else in doing so. So I think what we will want to see, of course, will be very well thought through transition plans built on sound risk assessment, sound risk appetite, over time incorporation of climate and other related environmental risks into loan pricings, for instance, etc. Seeing how banks do actually decarbonize their own portfolio via the proper provision of proper financing to a number of corporate sectors and so on and so forth, and basically ultimately how they reduce their risk, stranded assets, transition risks and so on, but I don't believe anyone is seriously considering mandating direct investment in one sector or the other.
To all the speakers, all the panelists, sorry.
Yeah, actually, yeah.
Yeah, sorry, yeah.
I just wanted to provide an answer also for the Mr. It is not that actually, let's say, NLB decides what to invest in entirely. I mean, in case of NLB, we're following also EBRD, environmental and social requirements, which means that we were given quite an extensive set of rules, you know, where to focus on and what can be financed and what not. We are also, our very important business partner is also MIGA, which is also one of the important financial institutions. So although this is not regulated, the exclusion list, but on the other hand, it is. Yeah, so it is not that, let's say, a small bank, a universal bank, just decides about things, but there is a mixture, I would say, of socially responsible behavior or acceptable financing. So, yeah, this is how it goes.
Okay, thank you again to all the panelists, all the speakers. With that, we are closing this event. I think we have got a lot of information, food for thought for the event next year. Hopefully we will be hosting it again in the same format. And I invite you to join me in a round of applause to all the speakers. Thank you.